Hi, we're here working on our practice final exam problems. And this first batch of problems is just some journal entries. And your first question on your final will be just some journal entries. It'll just be a bunch of journal entries. So here's some practice journal entries right here. I'm going to bring back our old friend, A equals L plus E, plus minus minus plus minus plus. Minus is how things decrease, plus is how things increase. So assets increase with debits, they decrease with credits. Liabilities decrease with debits, right? Flip over, opposite of assets. Increase with credits, same thing with equity. And expenses increase with debits, and revenues increase with credits. I always remember revenue on the right. So we're just going to do journal entries. We're going to analyze and decide, okay, what kind of accounts do we have? Therefore, what way are they increasing or decreasing? Do I need a debit or a credit? And I just will write down my journal entry. So we're just going to start with these entries and work them on. I've already made a little journal here. Alright, so you'll have that. Of course, on your test, you'll have a Word document, so this will kind of already be there. Alright, so the first set of problems are about Guadalupe's accounting, open for business, enter transactions, use the space. Okay, so we got 5 transactions. Opened a business bank account, so Guadalupe's, the company, opened a business bank account with a deposit of $20,000 in exchange for common stocks. Okay, so common stock increased, and of course cash increased. Right, so we have a debit and a credit of $20,000. And of course the debit is to cash. And our credit is to common stock. Alright, very simple transaction there. Purchased furniture on account, $1,500. Okay, so when you purchase something, in the future you're going to have to pay for it, so that's an account payable. So, a liability which increased, and of course furniture is an asset which increased. Right? So, the asset furniture increases by $1,500, and the liability account payable increases by $1,500. Next, provide accounting consulting services in exchange for cash. Okay, so we earned some revenue, right? That's what we do. We're an accountant consultant corporation. We did our job, so we've earned revenue. So cash. So we increased cash, and it's $6,800. So, of course, revenues are always credits, and of course, cash would be increased with a debit. So, cash, $6,800, and I'm just going to call it accounting revenue. If you called it service revenue or sales revenue, I would be fine with that. $6,800. Okay, so there we go. Next, provided accounting consulting services. Okay, so once again, did some work. So there's our revenue. On account, right? So this time on account would mean account receivable, because what we hope to do in the future is receive that. So $2,400, and of course, accounts receivable are assets, so that's our debit. It's increasing. Didn't have one before. Now we have an account receivable. And of course, same thing, accounting revenue. Whatever you call it, you need to call it the same thing because the same thing happened. And that's $2,400. $2,400. Alright, so there we go. Paid janitorial expense in cash, $125. Alright, so expenses are debits. So I'm just going to call that janitorial expense, just like the problem does. Of course, we paid for that with cash, and it was 125 debit and 125 credit. Alright, so some more. Let's look at these next transactions. List of adjustments needed to complete the accounting cycle for Chapman Hospital before the finance. So these are all going to be adjusting entries. Alright, so remember, adjusting entries never involve cash. They always involve either a revenue or an expense, something that hasn't been recorded yet. Alright. Of course, when it increases revenue, the revenue is the credit, and then some other account or an expense. So it'll always be one of these. Okay. So A, the first adjusting entry. Surgeries were performed but not yet billed. Okay, so that's a revenue, clearly. We are a hospital. We do surgeries, so that's how we earn our revenue. So we'll call it surgery revenue. The amount for these unbilled procedures is $175,000. Okay, so when you have an unbilled revenue, you're going to send out a bill. So that will be an account receivable. Clearly an asset that's increasing. So account receivable is increasing by $175,000. And of course we'll call it surgery revenue, $175,000. Okay, so that was clear revenue. Next, $15,000 of prepaid rent was used. So the hospital rents something, equipment, space, I don't know, but they paid it in advance, and now they've used it up. So when you use up something, that's an expense, right? So we'll just call it rent expense. Rent expense. And it's $15,000 debit, right? Expenses are your debits. And what you used up was the asset prepaid rent. Right? And that's because it told me we used up prepaid rent, which is an asset. Right? So decrease assets with credit, increase expenses with debits. There you go. Some medical procedures were paid in advance on December 1st. So remember, this is December 31st. So this is just like telling you back on December 1st this happened, posted as unearned revenue. The hospital has now earned revenues. The amount earned is $25,000. So, okay. So this is just telling you back then there was a transaction for this cash that came in, right? But we hadn't done the work yet, so we couldn't call it revenue. But now we've done the work, so we can call it revenue. So right now we've got a liability, unearned revenue, but we've paid it off by doing work. So we're going to decrease the liability, unearned revenue. And of course now we have our revenue, and it says procedures. I'll call it procedure revenue. I'm not really sure if that's different from surgery revenue, but it's got different words, so we'll call it different kind of revenue. And $25,000. All right. Office supplies need to be expensed. Okay, so right there we're going to know we're going to have office supplies expense, right? Expense, office supplies expense, so you know that'll be a debit. Hospital used up 5,200 supplies. So we're using up the asset office supplies, right? So that's our credit, using up the asset. All right, so we'll call it supplies expense, or office supplies expense, whatever you prefer. And office supplies, the asset. Alright, so the debit is to the expense, and it's $5,200. And office supplies, the asset, decrease, so that's our credit. Next, the CT scanner must be depreciated, and the expense for that is $10,000. Okay, so this is probably the easiest one because you can just memorize it. Whenever you do depreciation, you're doing depreciation expense for whatever it is. So we're going to say depreciation expense dash CT scanner. And then you go accumulated, right? You use that contra asset. Accumulated depreciation CT scanner, and that amount was $10,000. The expense is the debit, the contra asset is the credit. And you'll have a variety of adjusting entries on your exam. Not sure it'll be exactly those, but you know it'll be some revenues and some expenses and probably some depreciation. Alright, so here's some sale and purchase transactions. So another kind of journal entry we'll have to do. So on your exam you'll have 15 journal entries. They'll be all mixed up. They won't kind of be in order like this. They'll just be random entries happening. But you will have, the problem 1 will be 15 journal entries. They won't be any harder than these, but they won't be these exact entries. Alright, so purchased 5,600 of merchandise on account, freight and credit terms, or FOB shipping point, $315 net 60. Alright, so that just means we're going to pay for the shipping, and we'll get to that later. We got a discount, 3%, so remember this, 3% within 15 days, net within 60 days. So if we pay within 15 days, we're going to get a 3% discount. Otherwise, we just pay the whole thing within 60 days. So that's my terms. Okay, now 5,600 merchandise. On a purchase, you don't take the discount up front. You take it at the end. So that's the big difference between a sale. Of course, a purchase is when the merchandise comes in. And this is on account, not cash. So because we're making a purchase, this, and in the future we'll be paying. So this on account means an account payable. Alright, so we're getting some merchandise inventory, right? So that's an asset that we're getting. So, right, that asset merchandise inventory is increasing. I'm just going to abbreviate it, merch inventory, and it's increasing by 5,600, and we're not paying for it. We're going to pay for it in the future, so that's an account payable, 5,600. Next, paid transportation costs of $140 for this purchase. So this is what we're paying. So that's cash going out of $140. And remember, the distinction between a purchase and a sale. When you pay for shipping on a sale, it becomes part of the merchandise inventory. If you pay for, on a purchase, so like this is a purchase, right? So when you pay for shipping on a purchase, it becomes part of the merchandise inventory. When you pay for shipping on a sale, it's just an expense. Shipping expense, transportation expense, something like that. So in this case, this is going to increase my merchandise inventory, and you pay for stuff with cash, so it'll obviously decrease my cash. And it's 140. Of course, pay for stuff with cash. 140. Alright. Last few we do on the back. Alright. What's happening next? Sold 3,000 of merchandise on account to Tipsy Art. Credit terms 210 net 30, so 2% if they pay within 10 days. Net in 30. Cost of goods sold is $1,500. So the thing to remember about a sale, first of all, if there's credit terms, you assume they take it. So we're going to net out that 2% out of our sales revenue. And cost of goods sold, there's two parts to the transaction. So on a sale, you have those two parts. You have the revenue, right, where you get your sale and your account receivable. So yes, you get your sale and your account receivable. And then you have the expense part, right, where you have cost of goods sold, the expense, and the inventory decreases. So you've got like two separate transactions within one. Okay, so first of all, we need to real quickly calculate what this sale actually is, right? So we're selling 3,000, but it's 2% off, right? So 3,000 times 2% is equal to $60, right? So that's my discount, right? 3,000 minus 60 equals 2,940. So that's my actual sales revenue right there. All right, so we got our sale. Let's put that down. So the revenue is a credit, right? Sales revenue is a credit. And we're going to get the asset accounts receivable, right? Because it's not on for cash. So account receivable, 2940. And sales revenue, 2940. Then we got that second half, right? We've got the expense, cost of goods sold. So cost of goods sold is a debit. And we just tell you that it's 1,500. And of course, the merchandise goes out. We sold it. So merchandise is an asset. So we're decreasing it. Right? So merch inventory 1,500. All right. Next thing that happens, return $300 of defective merchandise that had been purchased on August 5th. So up here, when we did this $5,600 purchase, well, some of it we sent back. It was not any good. So we have to take it out of inventory, and we no longer owe it, right? Because when we first put it on the books, right, we put down that we had this merchandise inventory and this account payable. But we don't anymore. So we just do the inverse of that, putting it on the books, right? We no longer owe the account payable, right? So we're going to decrease it. Account payable. What did we return? We returned 300. And then, of course, we no longer have the merchandise inventory, so we have to take it out of our inventory, which is a credit, right? Decrease assets with credits. And that's that. All right. Paid, August 15th, paid within the discount period for the merchandise purchased August 5th. So, up here, we purchased $5,600, but we returned $300. So we actually only owe $5,300 now. But, look, we got a 3% discount if we pay within 15 days, which it is. In fact, it's only been 10 days, so great. So we have to calculate how much we actually pay them. All right, so let's see here. We've got the original $5,600 minus 300, so now we owe $5,300. Multiply that by 0.03 is equal to, excuse me, 159. 5,300 minus 159 is equal to 5141, right? 5141. Okay. So, we're decreasing the liability account payable, so that's a debit. AP, and the balance on it is $5,300, right? That's what we owe. But we're not going to pay $5,300. We're only going to pay $5,141. And this has to balance. So clearly that's that 159. Where does that come from? Well, it comes out of merchandise inventory, if you recall. Right? Because we didn't really pay for it. Right? Back here we said we paid $5,600 for it, but we really didn't. We really only paid $5,141, so we have to make that right. Okay. So, the last thing on August 17, received payment from Tipsy. So this is Tipsy, right? Sold $3,000, right? 210 net 30, cost of goods, right? That sale, they pay us for. So we just have to see what they owe us. Well, our account receivable is $29.40. We've already calculated the discount. So all we have to do is accept that cash from them is $29.40. And of course it's going towards that account receivable, $29.40. So there you go. That's how you work these problems. And on your final, you'll have a set of problems that will just be do all these journal entries. So it'll be a bunch of journal entries, and if you go back and review some of your old tests and practice your journal entries, you should be just fine.